the market, it sees as the equity market's finally catching up to what the bond market either has been saying or how the bond market has been digesting Powell's comments. I mean, he really hasn't diverted that much from his strategy, if at all. He's not saying anything new. It's just how the market's interpreting 25 basis points or 50 basis points.
Right. I think you're dead on, because it's been a lot of the same story, more or less, where he said that we're going to keep hiking, we're going to keep rates higher for longer, and as the hard data that we spoke about earlier has been coming in higher, markets have been starting to buy into that more and more, and that's where we've seen market rate hike expectations for the peak rate come into line with where the Fed has put it with their latest projection in December, and then now with Chair Powell kind of implying that's going to be higher than we had thought in December. So market expectations are now putting it closer to the 5.5 to 5.75 range, and the previous estimate that we had from the Fed in December was 5.25. So with the expectation that there's going to be a need to do a little bit more, market and Fed rate expectations have kind of aligned. And on top of that, with the Fed saying no rate cuts this year, markets have kind of been pricing that out for the most part.
So how does your team interpret it? Or should we expect to be in a higher interest rate environment for longer?
Yeah, I think so. And, the Fed has been very explicit this whole time that they're going to do whatever it takes to get inflation back to 2%. And if that means keeping rates higher for longer, even if that's uncomfortable for businesses or for consumers, and if it causes a recession, then they believe that's kind of the cost of doing business, because they see low, stable inflation as a necessity to set up the economy for another long expansion. So if for them, it's worth it to cause a short, mild recession if that sets us up for a 10-year expansion after that.
Right, and the thing is, if you're a business and you can make it through this environment, that should bode well for you when things, I don't know if we want to call it more normal, because historically, rates still aren't that high. What we saw over the past few years was more the anomaly, the exception, rather than the rule. So if you can make it either as a small business, as a private company, as a larger corporation, that does set you up well for when growth returns.
Sure. Yeah. I mean, like you're saying, the 0% interest rates that we had for the previous decade, that's kind of the historical anomaly. So if you're starting a business more recently, or you can get through this kind of period where we're seeing corporate rates much higher than we had in the previous decade, then that should make it easier, especially because the Fed is talking about longer term that the rate should be around 2.5% for the Fed funds rate, but they have to get inflation back to a sustainable place first. So once they get that done, they can start cutting rates again, and we'll see interest rates a little bit lower than the peak, but yeah, that should set companies up well if they can get through that more challenging period.
All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.